Hello traders, Gary Wagner here, just about 9:30 in Honolulu, 3:30 in New York on Thursday, 18th day of June, 2015, and this is the daily report for gold and silver. And what a good day to have a daily report for gold and silver. I've been humming, it's getting to feel a lot like Christmas, even though we're just beginning in the summer with the kind of move that we're witnessing across the board in the precious metals. Solid moves higher there. Equities markets moving back to record highs. The conclusion of the FOMC meeting yesterday, and then statements that were made. Now that they are digested, rather than focusing on the fact that in all likelihood there will be an interest rate hike this year, the focus is that there is no interest rate hike now and in the immediate future. And that's what has set these markets on fire today. Gold above $1,200. We haven't seen that in a while. This is a major breakout, up over 2% on the day. When we consider the range itself on gold, let's go ahead and move that out so we can see it. But when we consider the range, we're certainly trading near the highs at 1205.70, low 1183.10. And the market, according to eSignals database, is up about $25 on the day, up about 17 according to Kitco, and it depends on where you're fixing the open for the market itself, because these markets in essence are continuous. So it's where you actually close it out and compare the open on the following day is that price differential. Typically, when we have big moves in the precious metals, big moves in gold and silver, silver will tend to outperform on a percentage gain or percentage drawdown on the day. We're certainly not getting that today. Gold up over 2%. Silver, though, still a very strong, showing up about 20 cents on the day, or 1 1/3% higher, 16.15 on the day. That is our current price right now. In terms of our highs and lows, what we're looking at is a low of 16.02 and a high of 16.43 on the day. All week we've talked about the fact that this week, with the double whammy that we're looking at in terms of fundamental information, could provide many of the markets with the dynamic shift or pivot point. We certainly are getting that. Now, I'm not surprised to see gold higher. It is the amount of the net change today that really, quite frankly, took me by surprise. It's something I like to see. At the same time, it's something that I really didn't expect, this $25 rise in gold. But when you consider the fact that you've got the Fed in essence saying that interest rates aren't going up immediately, and then you have the worries that are over in the European Union about solving Greece's debt crisis, you really have a double scenario that in this particular case, the way everything is lined up is extremely bullish for gold as a safe haven investment. And we are absolutely seeing that pan out. Looking at our short-term chart, Japanese average format, that's how I want to start today's show. And an interesting thing in terms of our current Elliott wave count, the market has been in a defined downtrend as we saw this market move from 1240 down to about 1160. We can see that in that we have had our 5 count, and our 5 count has been a bear count. But this recent shift has moved it back into a bull count. So now we went 1, 2, 3, 4, 5. Rather than getting that standard ABC correction, we're looking at a scenario where we've now got a bull count of 1, 2, and it appears as though we are at the top of our third wave, or this rally here could take us as high as about 1220. Technical basis, we have some real resistance at about 1210 based on this top here. We have another level of resistance, call it 1217, right in that area, and that's based on this top. So as this market moves up, and we can see that in the MACD, where we had that nice price increase, we had a period of consolidation, and now we have this spike back up. We could expect this particular impulse wave to sustain itself for a little while longer. Let's go ahead and move this out. As I said, taking us anywhere between 1210 onto the high of about 1220. Following that, we should get a small corrective cycle, so we would get something similar to a 1, 2, 3, 4 should be anywhere between 38% in terms of our retracement. We'll chart that once we get to our top. And from there, we'll get a fifth wave, all things being equal, that will exceed the actual move that we saw in 3. And in terms of the price movement itself, what we want to do is take a look at our benchmark wave, which is our wave 1. When we consider, call it 65 up to 90, we've got roughly $25 to $30. So wherever we end up finding support here, in other words, assuming the market moves up, whether it stalls here or continues higher to this upper level of 20, then we would look for some sort of a retracement. We would look at it in terms of a Fibonacci-based retracement. So we'd probably look at that 38% level. And then we want to look at wave 1 and wave 5 roughly being equal. So depending on where the fourth wave correction takes us to, in other words, how deep into this most recent move, will determine really how high over the conclusion of wave 3, whether it's here or here, how high that actually takes us. But I can tell you this to me is an absolute breakout, and we have not seen this for quite some time. Yet another way to confirm this breakout, as if we need confirmation, but on a technical basis, consider this. We have had these defined channel lines, and we talked about the fact that we were really fairly range bound within there. We had a couple of areas in which it dipped below and above that, but for the most part, it tracked within this channel line. Clear, obvious, distinct, and strong breakout on today's move, this being our daily chart. So the last two charts that we looked at, in which we looked at our current studies, were all based on short and intermediate moves within the market. We looked at a 4-hour candlestick chart, our Japanese average, but 4-hour in length. Then we moved to our daily charts. Here we're looking at a weekly chart. And in a weekly chart, we can certainly see this real nice breakout, and there's actually a pattern that I want to talk about. It's basically a bullish harami and the confirmation of that harami. But the one thing in terms of a longer term cycle or move is this upper level descending set of tops that we have. From there, we can extrapolate a basic trend line that really lays out current resistance in the market. And when we do that, it's quite obvious that we need to breach this particular price point here, and that would signal really a strong breakout. Then this would obviously become support within the market. But when we look at this pattern itself, and for that, let's go ahead and blow this up. What we're looking at, as I said, is a bearish harami confirmation. Now, or bullish harami, excuse me. A bullish harami is after a defined downtrend. This is a weekly chart, so we've had 3 weeks of really lower pricing. Then you get, according to a Western trader, this is labeled as an inside trading week on a weekly chart, inside trading day on a daily chart, in which you have the entire body range, meaning where it opened to where it closes, because that's what's important in Japanese candlesticks. The highs and lows are looked at differently, but the most important area is where the market opened and where it closed. So you've got this inside trading day really at the bottom area of the former week's range, and then you get a defined breakout. Confirming candle would be a large green candle. We certainly got that. And the green candle, you absolutely want to see it trade and exceed the body of the red candle here. You're getting that. You also notice that the high of this last week, meaning the prior week, the high didn't exceed where the market opened on the prior week, and we are now well above that. And so when you consider all of these things and you put them together on our weekly chart, that spells bull, because what we're getting is the real potential for a defined breakout through the summer months. My only caveat to that is, as I said, when we look at our basic sets of highs that came in, these two higher lows, that absolutely is the area that you want to see taken out by the conclusion of this week, this already being Thursday, or at the onset of next week. That would signal a pretty strong buy signal in the marketplace. We certainly did not get in today. I wish I could tell you differently, but the patterns simply weren't there. As a market technician, we always are reacting on what has just happened. We're not really taking guesses in the market. We're acting on concrete, observable information. We saw that building yesterday, but certainly today we've gotten our confirmation of that, not only in our weekly pattern, but the confirmation of this weekly pattern. So as I said, we would look to either see if this marketplace has the ability to break through long term. Again, those shorter studies are simply looking at, even if the market's going to go up, it's not going to go straight up. So we're looking to really tune ourselves into the pulse or cycle for when these little corrections occur, because our entry point should be defined as the beginning of the next impulse wave and the conclusion of the current corrective wave. So that's when we're going to look to enter this market, and those are the parameters that we are going to base it upon. So silver is reacting a little bit differently, absolutely giving us that strong boost to the upside. However, when we look at silver, it looks as though in terms of timing, the timing is still there. We're just getting across our daily charts on the moving average convergence divergence. You can see that cross coming in here. And whereas when we looked at the gold channel, we had a defined breakout, kind of like this day here, a defined breakout to the upside. We're certainly not seeing that in silver. Although silver is trading higher on the day, we do not have it trading as close to the highs as we do have in gold. We don't have the same follow through that we've seen in gold. And in fact, if we look at a 720-minute to half a day chart, what you see is that the primary move in silver was made at the beginning of the sessions. And as we went into the close of these sessions, really what we saw was a retracement, market coming off those highs, moving to the midpoint of the prior candle. I'll show you what I mean. And I've gone ahead and pulled up the half a day chart. And you can see that the first part of this session, take a look at the body size, that long body size. In fact, when we basically by eye look at the same set of series of lower highs, we kind of put a channel line through there. In silver, we have a defined and definitive breakout that came at the beginning of the session, and now it's moved back. At the same time, our system is looking at this, unlike gold, which had a bull count, as still within a bear count, this being a corrective wave 4, that the system, meaning our Elliott wave count, is looking for a move to roughly 1660 in the market. From there, it's looking as though the market would then track lower. It's still within a bear count. The shift, the dynamic shift has not occurred there. It has occurred in gold. So we are seeing some really distinct differences between the way the two markets are trading. Nonetheless, we do have our cross in the MACD. We have backed off of these highs, as I said, and let's go back to our daily chart, which is here. But we've still got a nice track to the upside. And again, with silver, in the same way that I'm going to really look for it to break through this particular channel here, and also kind of look at the timing. In other words, on the smaller waves, try to set us into an area where we're actually triggering our buy signal at this pivot point here or at this pivot point here. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Friday for the weekly wrap-up. Bye-bye.